Welcome, everybody, to Consumer Confidence 101, your guide to home buying. We're delighted to have everybody here today. My name is Sarah Welch. I'm an outreach specialist for the North Carolina Department of Justice. I'm going to go over a few pieces of housekeeping, and then I'm going to turn over the microphone to our presenter for today, Keith Clayton, before we have a panel discussion with our panelists as well. First, we'll have a presentation from our Special Deputy Attorney General, Keith Clayton. Following his presentation, we're going to bring on panelists representing the North Carolina Real Estate Commission, NC Realtors, the North Carolina Housing Finance Agency, and the North Carolina Department of Insurance. All right, to go ahead and transition, I'm going to introduce Keith. Keith is our Special Deputy Attorney General within the Consumer Protection Division for the North Carolina Department of Justice. His focus primarily involves mortgage servicing and lending matters, real property issues, consumer lending practices, and policy issues. Prior to joining the North Carolina Attorney General's office, Keith was an attorney with the Mortgage Foreclosure Prevention Project at Legal Aid of North Carolina, handling mortgage foreclosure defense, mortgage servicing, and consumer bankruptcy cases in state and federal court. So Keith brings a wealth of knowledge, and we are very excited to have him giving today's presentation. So with that, Keith, I'll hand it over to you.
Great. Thank you very much, Sarah, and welcome everyone, and thank you for attending this presentation. As Sarah mentioned, I'm Keith Clayton, Special Deputy AG here at the Department of Justice, and I'm happy to be here today to share information with you about the process of buying a home. Just before I get into it, one friendly reminder, I'm not here giving legal advice to you today. This is just for informational purposes only. But if you don't know, North Carolina's Attorney General is Jeff Jackson. He serves as the top lawyer and the top law enforcement officer for the state. The AG guides our department's work, which is fundamentally to protect North Carolinians. So the department's mission is to protect the people of North Carolina, and we do that working to prevent crime and supporting law enforcement. We work to safeguard consumers and to defend the state, its people, and their constitutional rights. The department is made up of a number of divisions, one of which, as Sarah mentioned, is the Consumer Protection Division, which works to protect consumers through policy and public education, through events like today, as well as by investigating and prosecuting businesses and individuals engaged in unfair or deceptive business practices. And many times, those investigations are the result of complaints received from North Carolina consumers. And speaking of complaints, the Consumer Protection Division averages about 70 to 80 complaints a day. Some of the repeat offenders are telemarketing and robocall violations, motor vehicle complaints, complaints about credit issues, internet service providers, and landlord-tenant issues. But let's turn to the topic for today, why we're here. The home buying experience can be overwhelming. So let's break it into three main phases. We'll break it into a research phase, a purchase phase, and an ownership phase. So as a researcher, you will shop for financing options, you'll interview real estate agents, tour neighborhoods and homes. As a buyer, you'll make an offer, you'll get an inspection on the home, and then you'll close on the house. And as an owner, you'll make monthly payments and maintain the house and its records. So where to begin? You want to start with your budget and determine how much it is that you can afford. So in order to do that, you'll want to review your income, your current expenses, your existing debts, and any savings you have to assess your current financial circumstances. And in doing so, you'll be able to determine, I think, what you can realistically afford and set your expectations accordingly. You'll want to anticipate expenses related to home ownership other than your mortgage payment as well. For example, utilities, home repairs, homeowners insurance, property tax, and the like. You'll also want to get a sense of how much you can afford in a down payment. And just a quick note here, if you can afford to make a down payment of 20% of the value of the home, then you'll avoid having to pay for what's called private mortgage insurance. on conventional mortgage loans. And just briefly, private mortgage insurance is really of no benefit to you as a homeowner. It's really just a credit enhancement for lenders, again, for conventional loans. But notably, VA loans, at least as far as I know, don't require a down payment. And FHA insured loans also have different rules for mortgage insurance. But as a general rule, if you can afford to put 20% of the value down as a down payment, you can avoid that additional expense of PMI. Great, great. Once you have an idea of what you can afford, you'll want to research your ideal home, the ideal neighborhood where you'd like to live, and you'll want to look at the value of comparable homes in that area. You can view properties online. There are obviously numerous websites dedicated to that, and you'll want to view homes in person. Things to consider are if you know what school districts the home is in, if you have school-age children or if you plan to. You want to consider your commute and any resources or amenities that are nearby the home. Just beware of fake listings online in this day and age. Those types of things are becoming more pervasive. So as the adage goes, if something seems too good to be true, it probably is. We'll talk more about this in a minute, but you have the right to fair lending. And I think knowledge of your financial circumstances ahead of time will help to protect you from predatory lending from the get-go. So you'll want to know your credit worthiness, ideally before you start speaking with lenders. Your credit history and your credit score will determine how expensive your mortgage loan is likely to be. And obviously, the better your credit history and the better your credit score, the better your loan options will be. Now, you can obtain your credit history or your credit report free at least once a year at annualcreditreport.com. And when you obtain your credit history, you should scrutinize it carefully and check it for errors. And if you detect any errors on the report, you can dispute those directly with the credit bureaus themselves. Great. Should also consider whether you want to speak with a credit counseling agency to discuss your budget and how much you can afford in a monthly mortgage payment. Great. To find an accredited nonprofit credit counselor locally, you can go through the National Foundation for Credit Counseling at nfcc.org, or you can also visit the North Carolina Housing Finance Agency's website, and we have a link in the materials for that. They also have a list of housing counselors in your area that you can visit for this type of information and assistance. As you begin this process too, you'll also want to shop around for the best loan terms and the lowest interest rates. Even a relatively minor change in the interest rate can actually be pretty significant over the life of the mortgage loan. Great. Okay. So I think the first step in the process is to get a pre-approval or a pre-qualification letter from a lender. So you should note that a pre-approval is not the actual loan application itself. It's just a preliminary evaluation by a prospective lender to determine how much you will likely be eligible to borrow. But most sellers will want to see that you have pre-qualified before they will accept your offer on a home. So you don't necessarily have to ultimately obtain your mortgage loan from the same lender who provides you with the pre-approval or the pre-qualification letter. It's not a binding mortgage loan approval, but you do want to have that before you begin looking for homes. And those letters are usually good for roughly 60 to 90 days. And most lenders will provide a pre-qualification letter at no cost, although they may obviously charge you later if you submit a full mortgage loan application. One thing to note, though, is that this process of pre-qualification does involve a credit pull, which is an inquiry or a hit on your credit, but you do have a 14-day window from the first pre-qualification application in which to get other subsequent pre-qualification letters without an additional credit hit. So it's not a bad idea to consider getting more than one pre-qualification or pre-approval letter. And if you're going to do that, just make sure you do so within that 14-day window to avoid an additional ding on your credit report.
Great.
And also, we'll talk more about this in a moment as well, but there are state and federal protections against lending discrimination. So if you suspect lending discrimination, you should report that to us here at the North Carolina Department of Justice.
Great. Great.
One thing you'll also want to do is research homebuyer assistance programs. For example, you may qualify for certain benefits if you're a first-time home buyer or a military service member, veteran, or family member. Certain credit unions have buyer assistance programs, as do certain municipalities, certain towns. And also there are some home buyer assistance programs targeted towards lower income borrowers as well. And the benefits of such programs typically include down payment assistance or covered closing costs or assistance with closing costs. But you should note that these buyer assistance programs and the eligibility criteria for them do vary over time. And so in addition to doing your own research, you should ask your real estate agent and your lender about the availability of any such programs in your area for which you may qualify.
Great.
So once you've sort of gotten a sense of what you can afford and what your budget is, you'll want to find a trusted real estate agent. You should get recommendations from friends and family. And once you have some recommendations, it's not a bad idea to make sure that their license is in good standing, which you can do at the North Carolina Real Estate Commission's website. The agent that you're going to use should know the area in which the home you're looking for is located. And the agent's main sort of role will be to help you find properties and arrange for showings so that you can view those properties in person. You should feel free to meet with multiple agents as well. This is an important relationship, and you don't necessarily have to go with the first person that you meet. So some good questions to ask are, for example, how long have you been a real estate agent? Do you primarily work with buyers or sellers? Are you familiar with this area? And certainly you can ask them to provide you with references that you can contact as well. So you shouldn't hesitate to do that. So in doing your research, I just want to highlight some reputable resources that I would highly commend to you. Obviously, I've mentioned the Real Estate Commission and the North Carolina Housing Finance Agency, as well as the Foundation for Credit Counseling, but I also want to recommend the Consumer Financial Protection Bureau's website to you. There are a wealth of resources on the CFPB's website, both about borrowing and mortgage lending, but also about just the home buying process as well, the mechanics of buying a home. So I commend those resources to you as well, but I will note that the future of the Consumer Financial Protection Bureau is a little bit uncertain in this current administration. So you might want to visit that website and download their educational resources sooner than later.
Great. Great.
Okay, so in the housing market, so you've done your homework, you know how much home you can afford, you're pre-qualified and so on. So now it's time to actually start looking for a home in earnest. So once you start to find homes that interest you, you can and should ask questions of your real estate agent about the properties that interest you. And some examples here are, is there a homeowners association associated with this particular home, which we'll discuss more in a moment. Is the house in a floodplain? For example, if the home is in a FEMA designated floodplain, then you will have to maintain flood insurance on the home, in addition to a regular homeowner's insurance policy, which of course will be another monthly expense that you'll have to budget for.
Great.
You want to ask what appliances, fixtures, and furniture, if any, the homeowner is going to leave behind, refrigerators, that type of thing. And it's not a bad idea to get any important representations to that effect in writing. So if, for example, they're going to leave their refrigerator behind or whatever, it's certainly not a bad idea to get that representation in writing.
Great.
It's also, I think, important to understand that licensed real estate agents cannot misrepresent to you what they know about the house they're selling. And by the same token, sellers in North Carolina are required to provide what's called a seller's disclosure form, with information about the condition and the history of the property. So, for example, if the home has lead-based paint or other issues like that, those types of things have to be disclosed by the seller. And if the seller's agent, the seller's real estate agent, knows about those types of things, they have to tell you the truth about them.
Great.
Okay. So let's talk a little bit about HOAs, homeowners associations, and why they're an important factor to consider.
Great.
A homeowners association is a nonprofit entity that maintains common areas for the neighborhood. The HOA also sets rules and guidelines and limits for the properties in the neighborhood, and they can collect fines for violations of those rules and guidelines. The HOA's rules are typically made and enforced by a board of directors, which is usually made up of residents of the neighborhood. And most neighborhoods that are governed by an HOA require mandatory membership and payment of mandatory HOA dues for people who purchase a home there. So those HOA dues should factor into your budget. And HOA dues can really vary widely from association to association, but it is very important that you understand that a homeowners association can foreclose a home for unpaid dues and unpaid fees. So, that's, I think, one reason why it's just extremely important that you understand if a home that interests you is in an HOA, and if so, sort of what the declarations and covenants of that HOA provide for. If you have an opportunity, you can ask neighbors if they're satisfied with the HOA and its board members. But it's important to note that HOAs are not overseen or regulated by any state or federal agency. So if you have issues with a homeowners association, you'll need to hire private legal counsel if you're not able to resolve that dispute on your own.
Great. Great.
Okay.
Great.
So let's talk a little bit more about fair housing and equal opportunity to credit options. You have the right to fair housing and fair lending. There are several statutes that provide for these protections. There's the Federal Fair Housing Act, which prohibits discrimination by direct providers of housing, such as real estate companies and municipalities, based on race or color, religion, sex, national origin, familial status, or disability. Similarly, there is a federal Equal Credit Opportunity Act, which prohibits discrimination in lending along those same criteria. Separately, North Carolina has its own state Fair Housing Act. Also, some municipalities, Greensboro, Durham, Charlotte, Winston-Salem, have local ordinances to protect and prohibit, discrimination and protect fair housing. So you should report any suspected discrimination to the North Carolina Department of Justice, but also to an entity called the North Carolina Human Relations Commission. The Human Relations Commission is the entity that is vested with authority to enforce the state Fair Housing Act. I'll note that recently our office did sue First National Bank of Pennsylvania for failing to provide mortgage loans, predominantly for homes in minority neighborhoods, which is a practice known as redlining. We recently settled that case, and so in addition to prohibiting discriminatory practices going forward, the settlement required First National Bank to create a $12 million loan subsidy fund to help increase credit for mortgage loans in the Charlotte and Winston-Salem areas where they were doing business for communities of color. Okay, so when you're ready to make an offer, you've found the home that you're interested in, you're ready to make the offer, the seller's going to request a couple of things. They're going to request a due diligence fee, and they're going to request an earnest money deposit. So let's talk about those in a little more detail. The due diligence fee is a non-refundable fee that will vary by seller and based on market conditions and so forth. There's no standard due diligence amount. So the purpose for the due diligence fee is to provide time for you, the buyer, to conduct inspections of the home and to secure financing for the home It's usually around a 2-week period of time, but I think that can be negotiated between the buyer and the seller. You should be aware of substantial due diligence requests. These could signal that there are issues with the condition of the home. So if the due diligence payment is substantial, perhaps you will want to discuss with your real estate agent whether to include contingencies based on the results of the inspection report. So, for example, whether the sale price can be renegotiated if the inspection reveals substantial issues.
Great.
The earnest money, conversely, is refundable until it's vested, which is usually throughout the due diligence period. The purpose for the earnest money deposit is just to demonstrate that you're serious about purchasing the home. And again, it's refundable in most circumstances, but that is sort of based on the contract itself. Obviously, other terms of the offer are going to include the proposed purchase price and a proposed closing date, which is usually going to be 30 to 60 days from the date of the offer. And just be mindful that, once the buyer and seller both sign the offer to purchase and the buyer's notified, then at that point, it's a legally binding agreement. You as the buyer can still withdraw your offer, but you will lose the due diligence payment that you made up front
Great.
if you withdraw your offer.
Great.
Okay, so between the offer and the closing, which we'll talk more about in a minute, you will want to do what's called your due diligence. So once the seller accepts the offer, you'll apply for a loan. And as we alluded to earlier, you'll want to shop around for the best loan terms. One of the most important terms of any loan is the interest rate. And so let's talk a little bit about interest rates. Mortgage loans have either fixed interest rates or adjustable interest rates, and adjustable rate mortgages are commonly referred to as ARMs. But an adjustable rate mortgage typically will be fixed for the first 2 to 5 years, but then it will begin to adjust incrementally thereafter, typically adjusting upward. Without getting into a lot of detail about how adjustable rate mortgages, operate and sort of what the anatomy of an adjustable rate mortgage is, I would just say that they can be very complicated. There are a lot of moving parts in an adjustable rate mortgages. For example, what index is the interest rate going to track? Will there be a cap? Usually there will be, but what is the cap on the interest rate going to be? How often after that introductory period expires, how often can the interest rate adjust, and by how much can it adjust, when it changes? Is there a floor, right, if interest rates go back down? So if you decide to go with an adjustable rate mortgage, just make sure that you've asked the questions, that you fully understand how that adjustable rate mortgage is going to operate. Because obviously, if you're close to affordability, at the teaser rate, or what they call the teaser rate, the introductory rate, then once that mortgage begins to adjust after 2 to 5 years, you might be in a situation where making the payment becomes a little more difficult and a little more stressful. So beware of adjustable rate mortgage loans.
Great.
Most mortgage loans typically last for 30 years, although there are 15-year mortgages and some lenders offer 20-year mortgages as well. But it is a long-term commitment. There are also loans known as balloon loans that you should be aware of. A balloon loan requires a lump sum payment or a balloon payment at the end of the loan term. So, for example, if you're in a balloon loan, you've made your monthly payment timely and consistently for 30 years. At the end of that 30-year period, you still haven't necessarily paid off the mortgage. There's still a lump sum payment that has to be paid, whether that's $20,000, $30,000, $40,000, whatever it might be. And if you don't have that money saved up, then basically you're in a situation where you have to get another mortgage to pay off the balloon payment, and the cycle begins again.
Great.
You should also be aware of what I'm going to refer to as optional or add-on products. You'll want to decline any optional or add-on products that are unnecessary, that you don't need. And what I mean by optional or add-on products are things like credit life insurance, home warranties, credit monitoring services, title monitoring services, and those types of things. And the reason I caution you here is because these types of products are very profitable for lenders. So they're highly incentivized to sell these add-on products to borrowers. So just be sure that you understand whether, these types of products are being included in your loan. And if they are, be sure that you want them. And if you don't want them, you should instruct your lender to remove them from the loan.
Great.
Okay.
Great.
It's also highly, highly recommended during this due diligence period that you get a home inspection and that you review the inspection report once you have it. So you should choose a licensed home inspector, and your real estate agent may have some recommendations for you there. You'll want to check the inspector's license with the licensing board on their directory to make sure their license is in good standing.
Great.
Again, once you get the inspection report, you will want to review it carefully for any serious issues before you move forward and agree to purchase the home. And so I'll just remind you that you can negotiate concessions with the seller based on the inspection's findings. So for example, let's say the inspection report comes back and there's a leaky roof around the chimney or what have you. Well, that can be a very costly repair. So that may be a $10,000 repair, who knows? But you can go back to the seller and say, look, this is going to be an expensive repair, and ask for a concession from the seller for that amount of money to be, taken off of the sale price of the home.
Great.
But you should be mindful that any significant issues or repairs identified on the inspection report will need to be addressed once you purchase the home, regardless of whether you actually got a concession for that repair or not, because allowing major issues to remain unaddressed will lead to more significant and more expensive repairs down the road. So just very important to know, to review that inspection report carefully, to know what major issues may be revealed in that report, and to address those either through a concession or otherwise. Okay.
Great.
So some common pitfalls, some common things that we've been receiving complaints about recently. Wire fraud. Generally speaking, wire fraud, wire transfer fraud appears to be on the rise. So, don't change wiring details at the last minute. Don't make any wiring transfer changes based on outreach from people that you haven't dealt with or don't recognize. And just as a general rule, it's a good idea to verify the transfer instructions just before authorizing any wire transfer. You'll also want to be aware of high pressure tactics to skip inspections. Someone may say, hey, well, I'll knock the due diligence fee down to $250 if you agree not to do an inspection. And while that may be tempting, I would caution you that is a bad idea. Again, there may be some major structural issue with the home that an inspection report would reveal, so you'll want to be aware of high pressure tactics to forego or skip inspections.
Great.
You should also be aware of agents or contractors without licenses. A scenario where, let's say, the report comes back and there's a major repair that needs to be done. And the seller tells you, well, my cousin, Fred, he does this kind of work on the side. How about we let him repair it? No, don't do that. You must insist on using contractors who are licensed to do those repairs. And finally, beware of predatory lending. Predatory lending is as old as time, and it continues to be a pervasive problem. And it can range from things like the add-on products issue that I was just talking about, like adding credit life to your loan without your knowledge or consent, or steering, qualified borrowers to higher cost loans when they actually qualify for, conventional prime loans, or steering borrowers to what are called interest-only loans. You should avoid interest-only loans like the plague. You should also be aware of maybe what I'll call rent-to-own offers. Those can often be rife with pitfalls and red flags. as can be what are called installment contracts, which are basically a seller financing vehicle whereby the seller agrees to finance the purchase, but you don't actually take ownership or title to the home until you've made the final installment payment, 20 years down the road or whatever. All kinds of pitfalls associated with installment contracts. So beware of those types of arrangements as well.
Great.
Okay.
Great.
So you are ready to close, and so it's time to undertake the closing process, which can be extremely overwhelming. So you should definitely use a licensed North Carolina real estate attorney to close the transaction. At closing is where you sign the legally binding agreement to purchase the home and to borrow the funds for the purchase. This is where you'll agree to pay whatever the final agreed upon price is. It'll include any concessions from the due diligence period. This is when you'll make the down payment. This is when you'll take ownership of the home. There are many, many closing forms that you will be asked to sign at closing. Far too many for us to cover here today. But the two I want to flag for your attention are the closing estimate and the closing disclosure form. So the closing estimate is a form, a standardized form that reflects anticipated closing costs, the actual loan terms themselves, for example, the interest rate, the amount borrowed, and so forth. And this loan closing estimate must be provided to you within 3 business days after completion of the loan application. Now, it's important to note that receiving this loan estimate does not mean that your loan has been approved, but the lender has to provide you with this information within 3 business days nevertheless. So again, it contains important details about your loan and about your closing cost, and so you should review it carefully. However, the loan estimate numbers are just that, it's an estimate, but there are limits, legal limits, as to how much the final numbers can actually deviate from these preliminary estimates. Similarly, you should receive a document called the loan closing disclosure at least 3 business days prior to the closing itself. It's very similar to the loan estimate. In fact, we've got a slide with some sample documents in a minute that we'll show. But it's very similar to the loan estimate. But this is the document that reflects the final actual terms of the loan and the specific closing cost that you're going to be responsible for at closing. You should absolutely take time to review this document and ask questions about any terms that you do not understand or any numbers that significantly deviate from the loan estimate. And you should do this before you go to closing. Do not wait to raise these issues at the closing table. It will be too late to resolve these issues if you wait until that time. That is why the law changed, 10 years ago or a little more, to require that you be provided with this disclosure 3 business days before closing, so that you will have this opportunity to review the document. And so again, I don't mean to belabor the point, but you should review it carefully and raise any questions about the document with your lender. Another just sort of note of caution is that you should never sign incomplete forms or any documents with terms that you do not understand. And that goes for the whole process, throughout the application process, at closing, the whole time. If someone presents you with a document and it's blank, it's a form document, but all the blanks are not filled in, and they say, just sign it, we'll fill it in later, you should absolutely decline to do that. Let them know, I'll wait, I'll come back tomorrow, send it to me when it's completed, I'll sign it when it's completed. This was a big issue back in the 2008 housing crisis, particularly with loan applications, where unscrupulous lenders were having potential borrowers sign incomplete forms, and then after the borrower left, they were filling in inaccurate information about their income or their employment history and things like that, which can put you in legal jeopardy. So do not sign incomplete documents or documents that you do not understand. Okay. As you can see on the on the slideshow here, these are the first pages of the forms I was just talking about, the closing disclosure and the loan estimate. As you can see, they look very similar. That's because they basically are supposed to have the same information. Again, these are just the first pages. These documents are, I think, 4 to 5 pages long. But just so you'll know what they look like, these are the two documents that you should really focus on when you are going through the process of borrowing a mortgage and closing a home loan. Okay. Okay. So once you've purchased the home, what are some things you should be mindful of? You know, unfortunately, homes don't typically come with an owner's manual. So let's talk about a few things you should keep in mind. It seems obvious, but it's critical that you pay your monthly mortgage payment on time and precisely. We'll talk more about that in a second. It's also important to understand that most mortgages include what's called an escrow account for the property taxes and the insurance. So if your loan has an escrow account, the loan servicer, the lender, is responsible for issuing the property tax and insurance premium payments directly to the insurance agency and the tax assessor on your behalf. But in order to do so, every month they are going to collect a fraction of that amount that is owed annually. And since there's 12 months in a year, they will collect 1/12 of that amount with each monthly payment. You should also know that your escrow account is reanalyzed every year. Because your property taxes and your insurance premiums typically change from year to year, your mortgage payment will also change when your escrow account is reanalyzed every year. So even if you have a fixed rate mortgage and your principal and interest payment doesn't change over the life of the loan, your actual complete payment may and likely will change from year to year because of these incremental changes to your property tax and insurance, and thus the escrow portion of your monthly payment amount. Okay. By the same token, or the other side of that token, if your loan does not include an escrow account, then you will be responsible for making those payments to the insurance company and the tax assessor directly. So you'll need to have a plan to make those payments. So be sure to budget for those extra costs and stay current on your property taxes and your insurance payments. Because if you fail to pay your property taxes, your state or local government may impose fines and penalties or even place a tax lien on your home, which could ultimately lead to losing the home in a foreclosure or having to fend off a foreclosure. Also, if you fail to pay your taxes or insurance, your lender may and likely will advance those payments to the tax assessor or the insurance company themselves, and then add those amounts to your loan balance. Okay, and they will also then escrow your account from that point forward for the rest of the duration of the loan. If you don't make your insurance payment, your homeowner's insurance payment, the lender is going to purchase homeowner's insurance for you and bill you for it. And this lender purchased insurance is known as force-placed insurance, and it's typically far more expensive than a homeowner's policy you could obtain on your own. And it also doesn't provide any coverage to you, the homeowner. It only covers the bank. So it's very important that if your loan is not escrowed, that you stay current on your taxes and your homeowner's insurance premiums. Okay. I mentioned a moment ago that it's important to make your payments on time and precisely. So just a quick note about that. Even slight payment variations, like rounding up or rounding down, can lead to payment posting errors, which can then lead to bigger problems like late fees and property inspections and property inspection fees. So you should consider setting up an automatic draft for your monthly mortgage payment if you're able to do so. It's a convenient way to make sure that you make your payments accurately and on time and just avoid any issues. You know, loan servicing is highly automated, and most loan servicers now service hundreds of thousands, if not millions of loans. And so the way that the servicing platforms are designed, they are designed to receive the payment amount to the cent that is due for your particular mortgage. And so when that amount doesn't match to the cent, those funds are oftentimes put in what's called a suspense account or an unapplied funds account and not applied as a monthly payment to your mortgage. Therefore, your monthly due date doesn't advance. Therefore, late fees are triggered and property inspections and property inspection fees are triggered. So it's just extremely important that you stay on top of payments and making those payments precisely. Okay. What else should you do? Well, you should pay your other non-mortgage monthly expenses timely as well. You'll want to review your monthly mortgage statements and any other correspondence you get from your lender or servicer to make sure that the information is correct. So here again, just double check to make sure that last month's payment was applied correctly, posted correctly, that there are no additional fees or charges that you don't understand. You'll just want to scrutinize that monthly statement. Take the 5 minutes, look it over. It's absolutely worth the time. You'll also want to maintain important records in a safe place. Your closing documents are obviously important records that you should maintain. Your mortgage documents, your loan agreement, and proof of payments are documents that you should maintain. I recommend that you maintain your major appliances manuals, so refrigerators, heating, HVAC systems, all the important manuals you should keep in a safe place. You should also keep records from home repairs. Those are important to maintain and they come in handy further on up the road. It's also important to note that sometimes your loan servicer will change. So be sure to review any notice that you get that your loan servicing has transferred. So what I mean by that is, let's say you get a mortgage from ABC Bank, and very soon after closing, ABC Bank sells the mortgage to, I don't know, Citibank or Bank of America. And so you begin making your payments to Citibank or Bank of America, and everything's fine. But a year later, you get a notice that Citibank or Bank of America is transferring your loan servicing to Bank X. So those are important notices, so when you receive them, you should read them, make sure you understand them, make sure you understand where to send your payments, who should be, who you should direct inquiries to about escrow questions or other questions about your loan if you get a notice of servicing transfer. And again, just to put a fine point on this, contact your servicer, be proactive with any questions about mortgage payments, fees, escrow questions, anything you don't recognize. It's very important to be proactive. If you get in front of these things early, you can generally mitigate, the brunt of headaches and consequences further on up the road. Okay. Now, having said all of that, should you pay ahead if you're able? Well, making additional principal curtailment payments can help you save interest over the life of the loan, and you can pay off the loan a little earlier. So it's not a bad idea. But if you want to make additional payments towards the mortgage, you should be sure to specify that the additional payment is being submitted as a principal curtailment payment. Like I said a moment ago, when mortgage servicers receive payments that don't match the monthly amount, they generally put them in suspense or unapplied funds, and they're not applied as a payment to your loan. So you need to be proactive and be sure that you specify what your intention is when you submit the extra payment, the payment ahead. So designate it as a principal curtailment, and then keep a close eye on your monthly mortgage statements thereafter to ensure that that principal curtailment payment was properly applied to the principal only. Okay. Also, just a word of caution, you should avoid, if at all possible, making payments by telephone or using money orders or Western Union unless you absolutely must, because many servicers charge additional fees, and sometimes substantial fees, to take payments by phone, like, overnight payments, that type of thing. Those can be, unnecessary fees that you want to avoid. And of course, it costs extra to send a money order or a Western Union payment as well. One other thing that I think folks should be mindful of is that after you close on a home, many homeowners get a flood of junk mail. Why? Well, after your loan closes, your deed and other mortgage-related information are filed as public records with the Register of Deeds, and information like your full name, your mortgage lender, your loan amount, and your address then become publicly available. And some companies use this publicly available information about you or your loan to send you advertisements or even scams. So please don't assume that mail that you receive with your lender's name or other mortgage-related information on it is automatically affiliated with your lender. Okay, unfortunately, these types of direct mail solicitations often look very official. They use language like final notice and other, tactics to induce you to call them back, at which point the scam or the high pressure sales pitch begins. So when you get these types of, direct mail solicitations, and you will, read them carefully. And if you have questions about any particular notice or item that you receive in the mail, ask someone you trust, a trusted friend, housing counselor, an advisor, your parents, anyone that may have experience with these things to review it with you before you just decide to call the number on the notice and subject yourself to the potential scam or high pressure sales pitch. Okay. All right. And so if you get through this process and despite all your efforts to be proactive and to educate yourself and do your homework, you still encounter an issue, you should absolutely reach out for help. So if you encounter issues with, say, real estate agent misconduct, you should file a complaint with the North Carolina Real Estate Commission. They are the licensing entity for real estate agents in North Carolina, and they, are responsible for making sure that that their licensees behave in accordance with their regulations. If you're facing default, contact your servicer. Again, be proactive sooner than later. Don't, just sort of put it away and hope for the best and think maybe I'll make it up next month or whatever. The sooner you get in front of things like a potential default, the easier it is to try to work out some solution to mitigate that default and prevent you from ultimately potentially facing a foreclosure. Okay, so be proactive, and I hate to repeat that, but I think that's good advice. And for all other issues, let's say you wind up dealing with a contractor who's jerking you around, or you have some other issue related to the home, you should absolutely file a consumer complaint with our office, with the North Carolina Department of Justice's Consumer Protection Division, and we will investigate that complaint and try to mitigate a resolution and mediate, I should say, a resolution on your behalf. And with that, I will hand it back over to you, Sarah.
Awesome. Thank you, Keith. And then there was one other question, but it popped into the chat before you got to the slide about principal curtailment. And so Amir will just say that his question was, is it a good idea to pay a little additional to actual mortgage payments, sometimes if you can afford it?
Yeah, so I just want to be clear. So a lot of folks, I think, reasonably assume that, okay, well, if my mortgage payment is $950 a month, and I'm just picking a random number, I'll send in $1,000 a month, and, eventually that'll add up to an extra payment, and, and you're right to think that's a good idea. What I'm trying to caution you against, and I will say, I also, before I became an attorney, I worked in loan servicing at a large bank. So some of my caution is informed by that life experience, okay? The servicing platforms are highly automated, so they are programmed to receive your payment for $950. So when they get a payment for $1,000 in this hypothetical, that money is going to go to an unapplied funds account. And because there's enough there to pull from the suspense and apply it as a payment, that's likely what's going to happen. But you just can't assume that's what's going to happen. And that may not happen for several days. It may not even happen until your subsequent next month's due date comes and goes, in which case your due date will not have rolled forward because for all those 30 plus days, it just sat in a suspense account instead of being posted as a payment. to your loan. And so through no fault of your own, really, the bank thinks that you didn't make the payment because it wasn't the exact amount. It didn't get applied, through their automation. And so you can just wind up creating problems, again, through no fault of your own. So I would recommend that instead of just, rounding up or paying ahead like that, that you actually just pointedly make principal curtailment payments separate and apart from your regular monthly mortgage payment. So if you're paying online, for example, you should be able to navigate to your bank's website. There should be a drop-down box or something that says, like regular payment, escrow shortage, principal curtailment, select principal curtailment, put in whatever it is you want to pay. If you're not paying online, then I would do this. I would write in the memo of the check, if you're like me and you still write checks, principal curtailment. And then I might even include just a handwritten letter, to whom it may concern regarding loan number 1234. I am including this payment of $250 as a principal curtailment. Please apply it, to my principal only. Then I would go behind that and look at my monthly mortgage statement the following month and make sure that that's what happened. And if it didn't happen, get on the phone with them right away. Get in front of these issues because they can just snowball quickly and become headaches. And not only is this informed by, my own personal experience, but I've had many complaints from consumers where things got off track. Maybe a consumer didn't understand that when their escrow changed, their payment went up, so they kept on paying their prior payment, and things went haywire from there. And so those things are very hard to unwind after the fact, especially as more time passes. So probably TMI, sorry.
No, that's great. All right, we're going to go ahead and transition. I'll invite our panelists to come off mute and turn their cameras on. I would do the same, but my camera is telling me that it's not going to turn back on. So for the attendees, go ahead and put any questions that you have about the home buying process in the chat. All right, and Sarah's just dropped those in the chat, so thank you. All right, we're going to go ahead and hear from our panelists now. We're going to give them an opportunity to introduce themselves and their work. We'll start with North Carolina's Real Estate Commission, Janet Thoren.
Hi, everybody. I'm Janet Thoren. I'm with the North Carolina Real Estate Commission. I serve as their legal counsel and director of regulatory affairs. The commission is the state agency that licenses and oversees real estate brokers across North Carolina. Our main job is really about one thing, and that is protecting you all as consumers. Buying a home is pretty exciting, but it can also feel overwhelming, and the process is very stressful. And because it's one of the biggest financial decisions most people ever make, our role is to help make sure the people that are guiding you through that process are properly trained and qualified and are held to certain professional standards. So we work behind the scenes to license brokers, set their education requirements, investigate complaints about brokers and their conduct in transactions, and we provide a lot of free resources on our website, which is www.ncrec.gov, to help consumers understand their rights and what to expect in a real estate transaction. And I think Keith gave you a really great overview. That's a lot of information, but it's all very valuable for you to understand the process. So I'm really glad to be here today to share information and to answer questions and help you feel more confident as you move forward on your home buying journey.
Thank you, Janet. From the NC Realtors, we're joined by Caitlin Thompson.
Good afternoon, everyone. My name is Caitlin Thompson. I serve as NC Realtors Chief Legal Officer, so I oversee all of the legal programs and services for NC Realtors. We are a not-for-profit trade association, and we serve about 55,000 realtor members all over the state. We primarily exist to provide services and programs to help those realtor members do their job more effectively. So we do things like when you get into the home buying process, if you're working with a realtor, you will likely use some of the forms that we provide to our realtor members, as well as potentially some of the software as well to help fill out those forms. But I'm happy to be here today and see if I can answer any questions for you.
Thank you, Caitlin. From North Carolina Housing Finance Agency, we're joined by Kathy Ruffiange.
Good afternoon, everyone. I am Kathy Ruffiange. I'm the senior training coordinator with North Carolina Housing Finance Agency. I am also on the board of directors of the NC Realtors Housing Foundation and serve on the education committee. The NC Housing Finance Agency is a self-supporting public agency that provides affordable housing opportunities to enhance the quality of life of North Carolinians. The agency has assisted thousands of North Carolinians in purchasing homes. We offer an array of financing options to make home buying more affordable. Our products include the NC Home Advantage Mortgage, which offers down payment assistance up to 3% of the loan amount for first-time and move-up buyers. And the agency also provides $15,000 in down payment assistance called the NC First Home Advantage Down Payment Program. And that one is for eligible first-time buyers, which would be defined as someone who has not owned a home as their principal residence in the most recent 3 years, as well as military veterans. So in my role at the agency, I train lenders and real estate agents how to use our loan programs to get their buyers into their dream home. So thank you for having me today.
Thank you, Kathy. And last but not least, we've got North Carolina Department of Insurance's Lori Gooch.
Hi, everyone. My name is Lori Gooch, and I am a regulatory analyst with the North Carolina Department of Insurance. I have a background of over a decade in insurance, but our focus here is to investigate whether or not insurance carriers are compliant with insurance laws and regulations. So a lot of times you're going to get the angry customer versus the happy customer. But we work to be an advocate for the insured. We use North Carolina general statutes to advocate for the insured. We use policy language. So there's a lot that we do for the company, the consumer. The North Carolina Department of Insurance itself is a state agency that seeks to promote a stable insurance market through unbiased regulation, and we seek to protect the lives and property of every citizen in all 100 counties while fostering superior user-friendly service, courtesy, and respect. So that's us in a nutshell.
Thank you, Lori. I'll go ahead and start with one question for you, Janet. Could you elaborate on what's the difference between the North Carolina Real Estate Commission and the North Carolina Realtors Association? What differentiates the two of y'all?
Sure. The Real Estate Commission is a state government agency, and its role is to protect the public. That's our mission. We license and regulate the real estate brokers in the state. So to be a real estate broker acting in the state, you must have a license issued by the commission. We set education requirements for those folks, and then we enforce the license law and the commission rules in transactions. So we do that by investigating complaints. If a consumer has a complaint about their real estate broker, they can file that complaint with us online, and we do open a file and investigate those complaints where we have jurisdiction. We also hold hearings, and the 9 members of our board who are appointed by the governor and the General Assembly discipline brokers when those laws or rules have been violated. So you can think of the commission as the regulator and sort of consumer protection agency combined into one for real estate brokers. The Realtors Association, and Caitlin, I don't want to speak for you, but the Realtors Association is a trade or professional association. It's not a government agency. They represent their members' professional interests. They provide training tools and advocacy for their members, and they support their members through networking and industry resources. They also have a code of ethics, which they enforce. And so sometimes behavior by a broker or their conduct might amount to a code of ethics violation, but not a law or rule violation. And so the realtors handle those code of ethics violations involving their members. So every broker must hold a license from the commission, but every broker does not have to be a member of the Association of Realtors. That is a voluntary trade organization. You can think of them as a membership organization that supports the real estate professionals. Does that help?
Yeah, and I'll open it up. Caitlin, do you want to hop in too?
I think that's a great summary that Janet provided. I'll just mention, she talked about the code of ethics, and we have an enforceable code of ethics. So you may find yourself in a situation where you have a dispute with a realtor. There might be a potential to file a complaint with the real estate commission, but there also might be the potential to file a complaint with the realtor association, or go through some of our alternative dispute resolution processes like ombudsman services, which is telephone mediation essentially, or mediation. So those are some of the services that we provide to our members, but they also heavily impact their customers and consumers. And then in addition to the services that I mentioned, like providing forms to our members that help throughout the real estate transaction, as well as, dispute resolution or complaint options, our members also receive tools as far as education, throughout the year, in addition to their required CE through the Real Estate Commission, that can continue their knowledge and help them better represent their clients.
Caitlin, for someone who's thinking that they might go unrepresented through the home buying process, what would be the benefits of working with a real estate agent?
So, first I would say, I think Keith highlighted a lot of the complexities that come with purchasing a home. It is a very complicated transaction. It is oftentimes the largest purchase that anyone will ever make. And, home buying sets folks up for a lot of stability in their future. So having someone that is qualified to represent you, that has their real estate license, but also someone who has chosen to join the Realtor Association, who has chosen to abide by our code of ethics, has continued their education. Oftentimes we have realtor members who have a focus on working with first-time home buyers and helping navigate the lending process. So I would really encourage you to think about doing that, especially if it is your first time buying a home. It's very complex, and someone to help you along the way can really be invaluable.
Janet, would you talk about what the agent's duties are to a buyer? And of course, there's also the financial relationship between an agent and a buyer. So could you talk about how the Real Estate Commission does or does not regulate that as well?
Sure, it's a complicated question, but yeah, I'll touch on it as best I can here. A broker must represent someone in the transaction. So they're either representing the seller as the listing agent. They may be representing the buyer as a buyer agent. It's possible that they may also be a dual agent. A dual agent can help navigate a person through a transaction, but they cannot advocate for that person. So for that reason, particularly with a first-time home buyer, I highly recommend that they hire their own buyer agent. When they interview and talk with agents or decide that they are going to work with a particular agent, they will be offered or are required to be offered what's called the Working with Real Estate Agents disclosure. This is a disclosure that explains who the broker is going to represent in a transaction, and it's really important for you as a buyer to understand who the agent is representing and to make sure that they are going to represent you and your best interest in the transaction. That is not a contract. It is a disclosure form that the broker is required to give to a consumer at their first substantial contact with that consumer. So when they ask you to sign this disclosure statement, it simply says that they have disclosed this information to you about who they might represent in the transaction. It's not a contract at that point. You will be asked later on to sign a buyer agency agreement, and that agency agreement must be signed in writing no later than the time that you are going to make an offer on a property. This is sometimes referred to as this period before you sign a buyer agency agreement is sometimes referred to as a dating period, where you can talk to a buyer agent, look at some properties with them, and you might need to sign a touring agreement so that they can show you the house, but you're not signing up with them to be your agent until you sign that buyer agency agreement. Let you kind of get to know the buyer agent a little bit, and then make a decision about whether that's the person that you want to work with. You need to be able to rely on your buyer agent and know that they're going to have your best interests at heart. So a broker who represents a buyer has certain legal duties in the transaction, including being loyal to that buyer's interests. So they need to tell you everything about the property that they know. If they know that you're looking for something particular, they need to make sure that the property that you're looking at is going to suit your needs. So, for example, if you want to operate a business out of your home, your buyer agent, and you tell your buyer agent this and have this discussion, they need to make certain that the properties you're looking at will allow you to have a business out of your home and that there are no restrictions that would prohibit you from doing that. They're also required to follow the buyer's lawful instructions, whatever you might instruct them to do in the course of the purchasing process, as long as it's a lawful instruction, not some obstruction for them to disobey the law in any way. They must follow your lawful instructions. As I said, they have to disclose all of the important facts about a property or a transaction. A good buyer agent is going to walk through the property with you, show you that property, look for things in the property that are obvious, that they need to point out, that you might want to take into consideration. Recommend that you have certain inspections done. Keith talked about the home inspection, usually a termite inspection, and there may be other inspections that you might need. If the roof is a problem, you might need to have someone come out that is a roofing contractor to look at that. And so they need to do that. So they have to exercise a reasonable skill, care, and diligence in terms of helping you navigate through the transaction to make sure that you get the home that you really want, and that you understand all of the things that might be wrong with the home, or that might need to be fixed, or problems that might arise during the transaction. There should be a good communication between you and your buyer agent. They also have to account for any money or any documents that they take into possession. So when you sign an agency agreement with them, they're required to give you a copy. And when you sign other documentation, they're required to give you copies of that as well. If you give them money to make an earnest money deposit or something else with the transaction, they have to account for that money. And there are certain rules that they have to follow in terms of how they handle that. They also have to keep your information confidential and private. So they can't be sharing information that you might share with them that would be considered as confidential or private. For example, if you are willing to pay more for a property, they can't go and tell the seller or the listing agent, hey, my buyer will actually come up on their offer. They can't do that. They have to keep that to themselves. They're supposed to try to get you the best possible price on the property that you want. With all of that in mind, they still have the obligation to treat all the parties honestly and fairly. So they can't lie about something. If the seller asks them a specific question, they need to answer it honestly and fairly. If the seller says, hey, will they come up on their offer? They have to say, well, that's something I really can't discuss with you because I represent my buyer. But if you want to ask that, that's entirely up to you. But I can't discuss what information I have about that. They still have to treat everybody honestly and fairly. So in simple terms, I guess your agent should be looking out for you. They need to keep you informed. They need to protect your confidential information, and they need to act in your best interest in the transaction. And I think that pretty well sums up their duties.
I would agree. I think that's a great summary.
You also asked the fees. And so let me just say that the Real Estate Commission does not regulate or set or control broker fees. We don't have the ability to negotiate or to talk about fees being paid between brokers at all. But we do require that brokers' fees be set in writing in their contracts with their clients. So it does, whatever it is, has to be in writing. Broker fees are not fixed by law. They are negotiable and they can vary from broker to broker. So when you are interviewing and talking to buyer agents, you should talk with them about how their fee is calculated and what they might be charging you. And you should be prepared to pay a broker for the work that they do. What is regulated, of course, is that the fees must be disclosed, the agreements must be in writing, and brokers have to be honest and transparent about their compensation. So they can't be receiving money from someone else in the transaction and not have disclosed that to you. I think the bottom line for that is that you should definitely ask questions, compare, and discuss the fees that you're going to be charged for their services before you sign anything. The services are valuable, and the broker is not going to work for you for nothing. They shouldn't. But you need to know what those fees are going to be and be prepared for that.
Caitlin, I'll ask you, there in the news in the last few years, there's been updates to the federal law, the NAR settlement, affecting home buyers and the agent relationship. Could you talk more about what the current status is for realtor fees and commissions?
Sure, I'll try to summarize this as quickly as I can, but in 2024, the National Association of Realtors entered into a settlement agreement that introduced changes that were aimed to increase transparency in real estate transactions. There's no new laws that were passed, but the settlement significantly changed nationwide practices. So the first change I want to mention is not one that if you've purchased a home before, you would have seen as a substantial change in North Carolina, but really impacted lots of home buyers and agents all across the country. And that was that after the settlement, a buyer must sign a written buyer's agency agreement before touring a home. Janet mentioned this, and what we're seeing, pretty often is a touring agreement prior to a exclusive buyer agency agreement, which allows you to tour homes with an agent before committing to, more extensive representation. That touring agreement is limited services. But an agency agreement clearly outlines the agent's duties, the services that they're going to be providing you, and how their compensation or their fees are going to work. So again, prior to the settlement, agents could show homes without a signed agreement. The second major change that we saw as a result of the settlement was that offers of compensation can no longer be displayed in the multiple listing service. And the purpose behind this change was to encourage direct, upfront conversations between buyers and agents. And then finally, that compensation is fully negotiable. Compensation has always been fully negotiable, but the settlement reinforced the need for realtors to clearly communicate the compensation terms with their clients. If you are working with a buyer's agent, and we would encourage, just like Janet mentioned, if you are a first-time home buyer, to seriously consider doing that. If you're working with a realtor member, they are utilizing our forms, most likely with NC Realtors. We have an exclusive buyer's agency agreement. The fees for services paragraph is listed on the front page. So after you have gotten through your interviews with different agents You've talked to them about their fees or compensation. When you go to formalize that agreement, make sure you're paying close attention to that fee for services section and that you fully understand that and you have a very clear conversation with your realtor and you ask them many questions and get those answers that you need. Again, the changes in the settlement were designed to improve transparency and ensure that home buyers and home sellers clearly understand how they're being represented and how agents are being compensated moving forward.
Thank you, Caitlin. Kathy, people on this call who are prospective home buyers for the first time are probably thinking, I want to buy a house. I don't know if I can afford a house. I don't know if I qualify for first-time home buyers assistance. How can they learn from the North Carolina Housing Finance Agency if they qualify to receive assistance from y'all?
Okay, so what we do, and I answer many of these phone calls on a daily basis, our public website. Clients can either go to housingbuildsnc.com or nchfa.com. That will take them to the same page. There is a link for potential home buyers to walk them through all of our different programs. But my recommendation is always, as a first step, to talk with one of our participating lenders to get pre-approved for their loan using one of our down payment assistance programs. Our participating lenders, first and foremost, the company itself is approved by North Carolina Housing as well as our servicer. Once the company itself is approved, then each individual loan officer must also be approved. They would go through the training that I provide on a monthly basis. It's a 3-hour loan officer class. Once they complete the class, then they also have to take a quiz and pass that quiz with at least a 90% score or better. At that time, we list the participating lenders on our website based on their numbers with us. So the more transactions that the lender participates in, the higher ranked on our website they become. So a potential buyer could go onto our website. We do have a search section, if you will, where they can actually click on find a lender. They would type in the zip code that they're interested in purchasing in, and then from there they would find all of the approved lenders that work with our programs. Once they have decided, just like you guys are talking about with real estate agents, any potential buyer can certainly talk with several different lenders to get a feel for who they would like to work with. Once they have decided to get pre-qualified with that lender, the lender is going to process and underwrite that loan based on industry guidelines for the loan type, whether it be a conventional loan, FHA, VA, or USDA. Once that lender's underwriter has approved their loan, they then submit that file, and there's certain required documentation that our underwriters must review for compliance approval. The compliance approval is going to have some certain criteria over and above what the industry guidelines are for the loan type. So we do have some income and purchase price requirements based on the program that they're interested in working with. And there's also credit score requirements. Each borrower on the application must have at least 2 credit scores. If they only have 2, we use the lesser of the 2 scores. If they have 3 scores, which is normally what you would see, we use the middle of the 3 scores, and this credit score requirement is 640, unless they're purchasing a brand new manufactured home, in which case the servicer requires a 660 credit score. In addition to that, they must have a debt to income ratio not to exceed 45%. We again put that 45% debt to income ratio limitation in motion because we want to set the buyer up for success, not for failure. So we don't want them to have too high of a debt to income ratio, because keep in mind, the debt to income ratio does not factor in, things such as groceries, utilities, and also the income that we use is before tax income. So I think that's actually a quite healthy 45% debt to income ratio. Once we approve the loan, we let the lender know that the loan is approved by issuing a conditional commitment, and then the lender can then proceed with issuing our favorite phrase, which is clear to close. That's always the thing that the buyer wants to hear. Once the loan is clear to close, then the lender closes the transaction working with the real estate attorney. And then I always say the best thing next is moving into the dream home. So that is our process in a nutshell. But again, folks can go on to our website, find out additional information, and give us a call as well to get more information about our programs.
Hi, Lori. One of the things that prospective home buyers are going to be in the market for too is insurance and making sure that their new home is insured. What are the best practices for when someone is shopping for home insurance policy?
Of course, that's an excellent question. Some of the best practices I would say would be, first off, know what you're buying. As an agent, a lot of times people would call for a quote and you'd ask them, well, what's the square footage of your house? I don't know. What's the exterior of your home? I'm not sure. Those are very important things to know. Because if you think you have a 1,200 square foot home and you actually need to be insuring a 2,400 square foot home, you're underinsured. And your home is one of your most valuable assets. So what normally happens is your agent will put in all the features of your home, square footage, number of stories, and they put into what is called a replacement cost estimator. And that's like a software tool, and it's used by insurance professionals to calculate the total expense required to rebuild the home from scratch in the event of a total loss. And it's not like market value because it excludes the land cost. So just keep that in mind because a lot of people always look at the market value of a home, and we look at replacement cost to rebuild a home. Some other things to consider when you're shopping for home insurance is know what type of policy you need. Most people understand the basic detached structure as a homeowner's policy, which is called an HO3. But there are people nowadays even more buying condos and townhomes, and that can be very tricky if you don't understand what that means. Normally, a condo or a townhome is walls in, meaning there's a master policy in place, and the master policy covers certain things on the exterior. One of the most important things to find out from the master policy is if they cover the roof. And a question?
Well, I wanted to ask, I know we're running short on time, but I do know that consumers in North Carolina are especially concerned with flood insurance after major storms like Hurricane Helene. What would you, or how should someone determine if flood insurance is something that they should purchase for their home?
Sure. So just really quickly to give you the basic definition of a flood is a general and temporary condition of partial or complete inundation of 2 or more acres of normally dry land. And you can go to the National Flood Insurance Program website, but just know that they will pay for a claim that's less than 2 acres, provided that the water affects at least 2 properties. So knowing what flood is important. Factors that affect your risk of being flooded would be your property location. How close are you to a flooding source, like a lake or a river or ocean? And what is your ground elevation of your property? And probably one of the most important things I will try to squeeze in here and say is that everyone is in a floodplain. Perfect example of people wondering if they should get insurance. Think about a Hurricane Helene. how many people who lived at that high of an elevation ever thought they would need flood insurance? So it's all according to your risk appetite, really. Um, and if your mortgage company doesn't require insurance, you just have to decide what's right for you. And I guess just lastly, just to say that you have to think about flood insurance just like you would car or home insurance, where you could pay it for 10 years and never use it, but you pay a premium to transfer the risk. So that's the best way to think about it.
Appreciate that. All right, I have not seen any other questions in the chat, so I will go ahead and say thank you so much to Keith and Janet and Caitlin and Kathy and Lori for being here and sharing information, and of course also to all of the attendees who logged on. All righty, thank you all so much.